spreads aren't screaming recession of 500 basis points, and then it's just really tempting to look at the yield that you can get right now in fixed income and say, forget the spread, just buy it. Greg, how do you navigate that particular situation?
Well, so you have to bifurcate the risk. I think that's what's happening, is that investors are looking at the overall yield, which is a repricing of the risk-free and even the liquidity in the marketplace. Credit spreads themselves remain arguably pretty tight, so they're just above the average. That 750, 800 on high yield harkens back to a time when once spreads get past 800 basis points, high yield investors have been rewarded historically for entering the fray. But I think it's really interesting that investors are conflating the yield versus spread risk, and so yields are up. That's great news, absolutely, but you haven't seen a repricing in the cyclical part of the market, the default risk part of the market, and so I think spreads are still too tight here.
When do you expect to see that adjustment, Greg, and what's going to get us there? What's going to lead us towards that further adjustment in fixed income, towards what you just explained?
So I think it's data-driven, not surprisingly. It's been fighting the entire time, as I mentioned before. So I think the data has to soften. You have to start to see earnings roll over, margins compress, and so it has to become a fundamental story. So as of right now, it's just been a central bank repricing story, not a fundamental story. So I do think at some point that has to occur. If the thesis is that central banks globally have to hike in order to contain inflation and thus slow down the economies and into a possible recession, then that has to filter through credit spreads. And so I think it's just a matter of time. So I suspect, Jonathan, over the next 3 to 6 months.